You can't scroll right now without seeing the Federal Reserve pulled into the headlines. Questions about its power, its independence, and what all of it means for the markets. It can start to feel like the rules are shifting while you're still trying to make smart, long-term decisions. Today, we're going to make that conversation make sense so you can feel more in control of your future and your plan. I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. This week's Point Perspective isn't about making predictions. It's about getting clarity. We're going to break down what the Federal Reserve does and the most credible arguments on both sides of this debate. Do we need it or do we not? We'll connect that information to what you're seeing in the markets right now, and I'll explain why interest rates and the bond market often drive more of the story than political headlines do. By the end of this discussion, you'll have a cleaner framework for thinking through the noise without letting it steer your decisions. Now, let's talk about what you've been seeing in the markets, because this is where most investors get pulled in the wrong direction. When politics heat up, it's easy to assume that markets are trading on party headlines. But in reality, markets are usually trading on something much more practical, which is the cost of money and the expectations around it. Stocks aren't only priced on what a company earns today, they're priced on what investors believe it can earn in the future and what they believe they should pay for those future earnings. Now, that what we should pay part is influenced by interest rates. So if you want to understand why markets can swing so sharply, especially during election years, you want to watch more than just the stock market. You also want to pay attention to the bond market, because that's where expectations about inflation and growth and Federal Reserve policy often show up first. When bond yields rise quickly, it can typically mean one of two things is happening. First, investors may be demanding a higher return to hold those bonds because they expect inflation to remain elevated or for rates to stay higher for longer. Second, investors may simply be repricing risk because uncertainty has increased. So when that happens, the stock market often reacts too. Not because investors suddenly change their political beliefs, but because the math behind those valuations have changed. Higher yields can compress prices, especially in areas of the market that are most sensitive to rates. On the other hand, when bond yields stabilize or move lower, markets often get some breathing room. And that doesn't guarantee a strong performance, but it does help explain why the same political headline can land very differently, depending on what rates are doing underneath the surface. This is also why that question, which party is better for the market, can be so misleading. Different political environments can influence sectors differently. Policy priorities can affect things like regulation, government spending, taxes, and trade. Those priorities matter, especially for industries tied to manufacturing, energy, infrastructure, and defense. But markets don't move on intent, they move on impact. Those expectations are constantly being revised based on economic data and interest rates and, yes, the messaging coming out of the Federal Reserve. Whether people love it or hate it, the Fed is one of the biggest drivers of expectations in our modern markets. It influences the cost of capital, liquidity, and how investors price risk. And during politically tense periods, questions about the Fed's independence can amplify uncertainty because markets don't just price today's rates. They price whether they trust the process behind the decisions. So what is the Federal Reserve, and what does independence actually mean, and why do so many people disagree about it? First, the Federal Reserve is the central bank of the United States. It operates what is commonly described as a dual mandate. They focus on price stability and maximum employment. Those goals might seem pretty tidy until you realize that they can pull against each other, and that tension in the middle is where a lot of the controversy lives. The part most people misunderstand is that the Fed's influence is not just on what it does. It is also on what people believe it will do next. So let's discuss both sides of the argument, and let's do it in a way that's fair, substantial, and useful. First, let's discuss the critique. Why some people want the Fed abolished, or at the very least, severely limited. One critique is that repeated intervention, especially when markets are under stress, can train market participants to expect a rescue. Now, when I say market participants, I'm not talking about individuals like you or me. I'm talking about large institutions, banks, major funds, and the broader financial system. The concern is that if enough pain triggers policy support, risk-taking can then increase. So you hear phrases like too big to fail, and the argument is that this expectation can lead to more leverage, more speculation, and less respect for downside risk. Another critique is what some people call the asset price effect. When rates are suppressed for long periods, asset prices can rise. Stocks, real estate, private markets. Those gains tend to benefit people and institutions that already own large amounts of those assets. So critics will argue that this can widen the gap between asset owners and wage earners, especially in periods where inflation pressures everyday costs. Now, there's also the governance critique. Fed leadership is appointed and confirmed, not elected. Some critics argue that an institution with that level of influence should be more directly accountable to the public, which leads into the legal and philosophical critique that comes up, which is that the central bank represents an inappropriate delegation of power, or that the structure conflicts with how some interpret constitutional authority over money and currency. And finally, there's the policy critique. Some economists and historians argue that attempts to smooth economic cycles can sometimes create larger distortions later. The Fed may reduce pain in the short term, but increase fragility over time. These critics can point to historical episodes where they believe policy mistakes contributed to worse outcomes. Now, if we're being honest, these critiques resonate because they do contain some truth. But let's flip the script and hear the defense, why supporters say the Fed is necessary. Supporters argue the Fed is not perfect, but it is necessary, especially in a modern credit-based economy. The most important argument is the lender of last resort role. In times of crisis, fear can become a self-fulfilling collapse. Liquidity disappears, institutions pull back, and systems can freeze. Supporters argue that a central bank backstop helps prevent a financial plumbing problem from turning into a broader economic crisis. Secondly, supporters argue independence reduces political incentives that can worsen inflation over time. If monetary policy were directly controlled by elected officials, there could be a strong temptation to stimulate the economy for short-term popularity, especially around election cycles. They also argue that monetary policy is complex, and the Fed's research capacity and data infrastructure are designed to support decision-making in a way that political bodies just aren't built to do. Third, supporters emphasize expectations. Markets react less to the level of rates and more to the credibility of the institution setting them. Supporters argue that in a modern credit economy, monetary policy is foundational. The cost of capital affects borrowing, investments, business expansion, and consumer behavior. So in that sense, policy is not optional. It's already embedded into our system. And finally, there is the no perfect alternative argument. Abolishing the Fed does not abolish cycles. It changes how crisis and credit contractions would be handled. So supporters argue that we may end up trading a known set of flaws for potentially more volatile reality. The key takeaway is that this isn't a debate about heroes and villains. It's a debate about trade-offs and whether those trade-offs are acceptable. Stability versus price discovery, independence versus accountability, short-term support versus long-term distortion. There is no cost-free option, only different costs. And regardless of where you fall on the debate, here's what matters from a market and planning perspective. Markets price expectations, and when the process behind decision-making feels uncertain, markets will react. So from the experience of a financial professional, the practical goal isn't to have a strong opinion. The goal is to understand the system well enough that you don't get pulled in every direction when the conversation gets loud. And that connects directly to our strategic focus this week, because the most valuable thing you can build in an environment like this is a plan that holds up even when uncertainty is elevated. Every week, we're taking another step towards a confident, clear financial future. January has been all about building the foundation. First, you defined your goals. Then you identify the habits that support it. And this week, we're going to add the missing piece that so many people often overlook, and that is your tools. Habits and tools go hand in hand. Strong habits can fail if the system around them is weak, and weaker habits can succeed if the right tools are utilized. The goal is to reduce friction and make progress more simple and successful. So the question I want you to answer this week, what tools do you already have that can reinforce the habits you want to build? And when I say tools, I mean the mechanics that make follow through easier. Direct deposit, automatic transfers, alerts in your app, bill pay systems, scheduled payment, and something incredibly important are organized accounts, structuring your savings and checking accounts in a way that supports each goal. So for example, if your goal is to build investable cash flow, your tool might be splitting your direct deposit so a portion goes directly into savings or a brokerage before you have a chance to spend it. If your goal is awareness and control, which can happen as we make more money, your tool might be setting alerts for spending categories, or you might create a dedicated discretionary account that sets a clear boundary for guilt-free spending spending while your savings and required expenses remain untouched. I call these burn accounts. This week is about identifying what you already have access to and making sure your tools align with your goals and the habits you're trying to strengthen. Because next week, we will put it all together. We'll be creating our action plan. Who will do what, how much, and when. So your plan becomes operational instead of just aspirational. Now, before we go, here is the practical takeaway. You don't need to resolve the Fed debate to manage money well. You need to understand what's being priced and why. And when you understand what the system is optimizing for, you can stop reacting to the volume and start focusing on the variables that actually move outcomes. This week wasn't about taking a side, it was about understanding the system well enough to stay calm inside of it. I hope everything we discussed adds some useful perspective. Until next week, take care.